Hi, this is Nathan Smith. I'm making this video for my students in Economics and Business in Visalia and North Fresno. And this chapter 15 is on capital budgeting. So first of all, what is capital budgeting? Process of planning expenditures that give rise to revenues or returns over a number of years. Let me dig a little under this. What's capital, first of all? Capital is some asset that is productive and it isn't used up in the process of being produced. You can call it a produced factor of production. Most typically, or most simply at least, this is things like structures and equipment. But you can also have you can also have human capital. You can also have something sometimes called organizational capital. You can have things like a brand name can have a lot of value, and a lot of times a team may have a lot of value to certain synergies within the team. And certainly intellectual property can have value, and there's a lot of different forms of that. And trademarks, copyrights, patents, that kind of thing, and then just product design, product development. Lots of things can have this sort of capital form. So this has been stated in a kind of a general way: expenditures that give rise to revenues or returns over a number of years. Anything that gives rise to a revenue or return over a number of years. In principle, anything that does that. Now, there may be conventions within particular organizations of what is counted as capital budgeting and what isn't. But if you engage in a hiring process, maybe it's expensive to find somebody who's suited to the particular role. You might spend a lot of money trying to hire that person, trying to find the right person and then hire them, and then they could stay with your organization for many years. And you'll be making some money from that the whole time. So, so that could be thought of as a capital expense as well. So the point is, this is planning for the future. This is all about the medium run, the long run. That's what capital budgeting is about. Okay, investment, that's another term here. So investment is the creation of capital. So you invest in more capital. And it has a little bit different meaning for a company than for individuals. I mean, when I taught an investments class undergraduate, that was all about basically buying stocks and bonds, putting money in the stock market and trying to make stock and bond markets and trying to make returns on that. That's not exactly what it's meant here, because investment in that sense is just trading claims to ownership over corporations or various streams of income. But here we're talking about never mind who owns the company. The point is that the company is acquiring or creating assets that are actually productive. So machines, structures, that sort of thing. Or teams that know how to work together. Or brand names that customers value. Or new designs for products. But the point is, it's not a matter of ownership claims. It's a matter of it's an actual something that is productive. So, different categories. Replacement. Machines wear out, structures wear out. I guess there's employee turnover as well, so you might need to invest in training. Products become unfashionable or become obsolete. Particularly with capital and equipment, then it just needs to be periodically replaced. So that would appear here. In principle, this could be extended to other forms of capital as well. Cost reduction. So in this case, maybe there's a new machine that's come out, or a machine that's maybe been available for a while, but that you've just decided you think it's worth buying. You might be able to just keep your volume the same, but you can actually lower costs by changing the way you do business. We talked a good deal about the substitution of capital for labor in some previous chapters. So if you think about how that's actually done, well, that would be investment. It's through investment is how you change your capital stock, just by definition, and it would be specifically with the motive of cost reduction. Okay, another reason. Accommodating demand increases, so maybe you're not doing anything all that different, but you just there's more demand for your product, and so you need to expand. Probably you have to have more inputs if you want to expand production. And probably you need specifically more capital inputs. And so you need to make a plan to invest in capital, and then you can accommodate the new demand. New products. So you might start doing something new, offering something new to the public, a new menu item, a new class, new college course, whatever it is, and so then that will require investment as well. And sometimes government regulation requires investment. There might be new safety regulations. There might be new training standards. There, for various reasons, government regulation might require you to invest. Okay, so we're going to talk about this a little bit as if it's a market, but it's not exactly a market because most of the decisions are actually being made internally, although you might, often you'll get your capital from outside sources, and but it's nonetheless useful to think of it as demand and supply. So demand for capital, where does that come from? It comes from investment projects. And you might have a lot of different investment projects, and you can think of the investment projects as demanding capital. The investment projects promise to pay off in future. Right now, they involve incurring a significant cost, and investment projects can be ordered from highest to lowest return, and that makes them look kind of like a demand curve. So typically the ones you want to do first are the ones with a high return, but the projects are usually not mutually exclusive. Generally you'll be able to do several of them at the same time if there's several projects which all offer a rate of return that's higher than the cost of capital. So that's demand for capital. On the supply side, where do you get capital from? Well, some of it you can just get internally. You might have revenues, just leftover revenues from previous years. Businesses are often in the position where they just they're making money over and above their costs, and they can decide what to do with it. They can dividend their shareholders. That's one thing they do. Most companies do that at least sometimes, but that's sort of optional. I mean, sometimes there will be an established practice at a particular firm to keep dividending their shareholders, so that if they were to, miss a dividend, then it would make them look bad and reduce confidence in their stock. But they're not legally obligated to do that, so they could if they have some good use for the capital, then they could just not pay a dividend. And some companies don't pay dividends at all because they've got lots of good uses for the capital internally, and they would rather just make the shares rise in value by expanding. If you don't have enough internal sources of cash, then you can go to external sources. So you can go to banks and take out loans, or you could sell bonds, or you could issue new stock. And there's actually lots of different ways that this can be done. But generally speaking, the more capital you need to raise, the more you're likely to have to pay for it. So you're going to exhaust the easier sources, and investors who put money into your projects are going to expect a higher return. You're likely to be perceived as riskier. So capital will have an increasing marginal cost. Now if you put these two together, you get the idea of an optimal capital budget. This is where you undertake all projects where return is greater than marginal cost. So of all the possible projects you can undertake, you arrange them from highest to lowest return. You see which ones are offer higher returns than the cost of capital, and you do all of those, but you do none of the ones that don't offer higher return. Now this gives an example. See, there's 5 projects. This firm has 5 projects. They're in varying sizes. So A is 2, B is 3, C is 1, D is 2, and E is 3. And they offer different levels of return. Return is measured in percent in this case. Well, 3 of these projects turn out to be worth doing, A, B, and C. D isn't, and E isn't. Why? Well, because if you look at the marginal cost of capital curve there, it's under the levels for A, B, and C. So for each of those, then then the cost of capital is somewhere between 10 and 12%, and the returns that you're getting are between 14 and 18%. So those are worth doing. Now, when you get to D, D offers a lower rate of return than A, B, and C. It offers an 11% rate of return, and that's below the marginal cost of capital at that point. So it's not worth financing D. But if you notice, if you push D all the way back to the back here to the x-axis, if you put D in the place where A is, then 11% would look like just barely worth it. I mean, narrowly, but it would be just barely worthwhile at that point, because there the marginal cost of capital is 10%. So if you arrange these differently, if you put D first and then you put A, B, and C, and C I think might still be above. I think it would still be worth doing. You'd actually finance A, B, C, and D, but that would be a mistake, because given that you know you're going to be financing projects A, B, and C, then that'll push up your cost of capital, and you would basically be comparing, you would be measuring D by the standards of as if it's just 11%, but you're actually pushing up the cost of capital for all your other projects, and so taking that into account is not worth it. So this is the correct way to make this decision: A, B, and C, A, B, C, D, and E in descending order of rate of return, and then the marginal cost of capital, and you look for the place how many projects pass the test. Okay, so, well, where did we get this rate of return from? So that we're going to start to go into some detail about where that comes from, and there's not really a single right way to do that, and we like to be mathematically precise when we can, and in this case, we can't quite be mathematically precise about everything, but we have to make a couple kind of arbitrary decisions in this. But okay, so projecting that cash flows. So a few tricks. So net cash flows are, well, they're the returns. They're not they're the returns in dollar values. And that's not what we need. For this, we need a percentage. So we'll see how to translate it from dollar values into a percentage. But that net cash flows is the place to start. Net cash flows you want to measure on an incremental basis. So incremental basis means how does, at the margin, how does it change my cash flow? So, if you, let's suppose you get a second building, the cleaning crew charges $20,000 for the first building, and then they say, well, if you want us to do 2 buildings, we'll charge you $30,000. Now, maybe they would charge $20,000 to do the second building, but if it's only going to raise it by $10,000, that would be measuring costs on an incremental basis. Net cash flows, by the net means net of cost. So you take out your costs, and then you see how much you have left over. So that's the net. After tax basis, you also want to take out what you have to pay in taxes. So you take out your costs, you take out what you pay in taxes, and you measure it in an incremental way. Another place where this could be tricky: if you introduce a new product that undermines the market for one of your other products. Let's say it's similar, and so if we introduced a new business degree at Fresno Pacific and it directly conflicted it, some of the people who would have done one of our other business degrees do the new one instead. Then we'd have to take that into account. Have to look at that on an incremental basis. Say, are we getting more students altogether? Not just how many people are going to go to the new degree. Actually, an even simpler example. Let's suppose McDonald's introduces a new hamburger. Well, it would be really naive for them to say, how much are we going to make by selling the new hamburger, and just stop there, because the new hamburger may be that people come into McDonald's wanting to get a hamburger, and they pick the new one. They would have bought one of the others. So in this case, you'd have to say, well, how many people came in there or stayed because the new hamburger was on the menu, because they had the extra option, who wouldn't have come without that being there. That would be the incremental basis. So, and then after tax basis, you've got to take taxes out. The other trick here is depreciation. Depreciation, conceptually, it's the idea that capital assets, they last a while. That's what makes them capital assets, by definition. But they deteriorate over time. So machines break down or become obsolete. Structures gradually decline too. Vehicles, whatever the capital asset is, it's gradually going to deteriorate. And so the government takes that into account and allows that to affect the way taxes are measured. But of course, if you're not actually selling the capital assets, if you've got, you don't have a market measure. I mean, if you have a car, let's say that one of the assets of your company is a car, and then you sell the car. Well, you know how much it's worth and how much value it lost. But if you don't sell it, you don't have a market measure of how much it's worth. That's not going to be objectively measured anywhere. But there are rules by which we measure depreciation. So this is a non-cash expense. You're not actually spending, if your car depreciates by $2,000, you don't actually spend that, but it does affect cash flows because it affects taxes. So here's an example of how these are calculated. $1 million worth of sales, subtract 500,000 variable costs, 150,000 fixed costs, 200,000 in depreciation. So we subtract this before and then we calculate something called profit before taxes. Then we subtract the income tax, so 60,000 profit after taxes, and then we add depreciation back in. And the reason for that, it's not that depreciation isn't a genuine expense. It is, but we're going to deal with depreciation in a little bit different way for our own purposes. And so ultimately we ignore that. We just develop this profit before taxes line where we calculate the income tax. Then when that's done, we add depreciation back in. So there's net cash flow. Net cash flow shows up here. We call it now return. We give it this label RT, and then it pops up in this estimate of net present value. So what is this net present value? Net present value it's kind of a measure of the returns to a project, but it's not in percentage terms, so it's not what we need for this previous chart that we were looking at. But the key thing we do here, well, okay, first we take the net cash flows. We discount them by how far in the future they are. So that's why the T appears here in an exponent. This is summation. So we go from year 1 to year n. We go through the n years. For each year, we take the cash flow. So the cash flow is 4-year T. But then we divide it by this value. And you notice because the K risk-adjusted discount rate, it might be 10%, for example. But that's kind of like an interest rate, but we, again, do this adjustment for risk, but never mind that for now. But the point is that this, inside the parentheses, will be something more than 1. As you take to the power of t, as t gets bigger, it's going to get bigger and bigger. That means that this quantity will be smaller. If you think about something 100 years in the future, that's basically going to be completely discounted. I mean, I think 1 plus 10% to the power of 100 is like 1,000 or something, or more than 1,000, I think. So, and so at that point, you're dividing your future profit by 1,000. That basically doesn't matter. So net present value is going to depend mainly on the next, 10 years or so, or maybe 10, 15 years, maybe. Certainly, unless some of these net cash flows are expected to be really huge, maybe you'd look further in the future for that. But whatever, it's mostly relatively near term, or medium term. Now, then you subtract the initial cost of the project. So this is the value of all the net cash flows you'll get. Then you subtract the initial cost of the project, and then that gives you the net present value. So you notice we're not forgetting the fact that we had to pay some capital. Pay something for our capital up front. We're just taking that into account in a little bit different way. We're not worrying about depreciation. Never mind what the depreciation rate is. That doesn't appear anywhere here. But it will implicitly show up. It will show up in the net cash flow values if it reduces our sales. I mean, if eventually your capital is too depreciated, you can't produce stuff you can't sell. So, okay, here you notice it doesn't. I don't think we were told what the value of this investment is. If somehow I remember, I think it was $1 million. But anyway, assume this last 5 years. This tells you your sales, so it's increasing by 10% each year. Variable costs are increasing by 10% each year as well, but fixed costs are not. Fixed costs are level at 150,000, and the depreciation is level. And then we have 2 measures of taxes. So taxes before profit. We have measures. We have a measure of profit before taxes, and then profit after tax. So 2 measures of profit. So and of course after tax is more relevant because you don't get to keep this money, so that goes to the government. And then depreciation gets added back in. That's the trickiest part of this table. So we add depreciation back in. That gives us the net cash flow because we didn't actually have to pay this cash out, so it just affected taxes. Then in year 5, salvage value of equipment. We sell equipment off for $250,000, and then working capital. What's working capital? Well, working capital is typically in a production process. You need to pay workers. You need to pay electricity bills. You need to pay for raw materials. You need to pay most of the expenses of production before you get the sales. So that means you need some capital to sort of tide you over until you actually sell the money. Sell the product. So we assume that's 100,000, and we add that all back in. So you're liquidating the enterprise after 5 years, liquidating the project, that is. Then you add that back in, and you end up with this 779,000. So the net cash flow for the last year is a lot bigger. And notice, again, this salvage value of the equipment is less than the original value. So in that sense, we do get to take depreciation into account. Okay. A couple measures. First of all, this idea of internal rate of return. This is the answer to the question. What rate of return would you need on your capital to end up with an equivalent value? So what discount rate would set the total value of the net cash flows equal to the initial investment? So if you think about this discount rate, you're discounting future cash flows. There would be some rate at which you could discount these cash flows that would make the value of these future cash flows equal to the initial investment. So that's called the IRR, the internal rate of return. Now, net present value and internal rate of return are 2 different measures of the value of a project. If you're comparing 2 different projects, then you might come to different conclusions depending on which of these methods you use to evaluate them. So we got here project A, project B. Project A initially costs 100,000. Larger returns later, 500,000, then a lot in year 5. Project B, it just gives you a steady stream of 350,000 for 5 years. So if you measure this in net present value using a discount rate of 12%, now where do you get that from? Well, maybe that's the cost of your capital. But then project A looks more appealing. If you use internal rate of return, then project B looks more appealing. So which of these is the better approach? Well, there's no really hard and fast answer to that. I mean, if you can definitely get the capital at this rate, then this may be more relevant. But project B, you notice this 22%. This fits more with what we were wanting to when we were making this chart before, we were looking for a percentage. So the net present value, when we got that, that doesn't give us a percentage. You see it here. Net present value, 1,378,000. That's a dollar value. The internal rate of return, that gives us a percentage. So that makes it easier to compare projects. The weakness of internal rate of return is really that, you say, well, first of all, why is the internal rate of return higher for this than for this one? The reason is fundamentally that this net present value method is putting more weight on these large future net cash flows. Putting more weight on them because it's discounting them less, because it's discounting them at 12%. Here you're discounting them at 22%. Or 20% or 22%, certainly more than 12 anyway. So if you're discounting these future flows more, well, it's going to look less appealing to get this big payoff in year 5 relative to getting a steady stream of income. If you just measure the cash value in a completely naive way and just add it up, this is 2.3 million and this is 1.4 million, but that would be a stupid way to do it, because whatever method you use, you certainly value the cash flows in year 1 and year 2 more. The question is how much more. Is it at a discount rate of 12% or a discount rate of 20 or 22? So internal rate of return, it kind of gives us what we want, as in the sense that we get a percentage, and which is therefore comparable across projects of different sizes. But it might put too little weight on the future, or too much weight for if in fact our cost of capital were lower than the internal, or were higher than the internal rate of return. But that's not as relevant. Usually if you're only going to pursue projects which offer a return higher than your cost of capital. Okay, so we're talking about capital rationing. We've actually been talking about it for a while. I mean, the whole idea of this is capital rationing. You're choosing which projects to do. Well, the best way to do that may be using this thing called the Profitability Index. And here it's just the net present value divided by the cash flow. So net present, and so now let's look at the elements here. So net present value, so this is familiar. You notice the top, when you define net present value, it's not the net present value, actually the present discounted value. I misspoke there. So the net present value subtracts the cash flow. What we have here, that you don't subtract the cash flow. This is the present discounted value of all the future net cash flows. But the cost of the capital, the initial cost of the project, we do not subtract here. Instead, we divide by the cost of the initial capital. So this tells you, for $1 invested, how much do you get in present discounted value of future cash flows at whatever the relevant risk-adjusted discount rate is. And if you have a good idea of what the risk-adjusted discount rate is, I mean, if you really know, our cost of capital is 12%, then okay, you can plug that K into the denominator here, make that calculation, you get your profitability index, and in that case, this is a little bit of a better measure of the relative value of projects. So this can also compare projects with unequal costs. I mean, you can see how you certainly want to be able to do this when you go back to this. These projects have unequal costs. So to rank them into this way, you can't say what's the net present value. Probably D is going to have a bigger net present value than C because it involves a higher initial investment. But that's sort of beside the point. This profitability index that is comparable across different projects. So here's an example. Project A, Project B, and Project C. Project A is bigger. And so if you measure it in net present value terms, Project A has a higher net present value than the other two. But if you measure it in terms of the profitability index, then it's 2.6 million divided by 2 million, 1.3. These ones actually yield higher returns. So, so you'd be better off probably if you, if you have scarce capital. I mean, you might want to fund all three, but if you're just going to fund one, you would want to do one of these, or if you're going to do two, you would want to do these two. And Project A should probably be a lower priority because in terms of the profitability index, it's actually not that much. It's expensive. In fact, you could actually finance both of these projects for the same price finance B and C for the same cost as Project A, and you'd certainly rather do that because you get 800,000 together, and this profitability index then provides a measure of that. So the profitability index actually, it's not a percentage exactly. It's a 1 point something. I mean, it could be less than 1, but if it was less than 1, you wouldn't want to do it. You'd only want to do it if the price is more than 1, and then and so this provides a way of rank ordering. The internal rate of return, for all its weaknesses, that's the only one that really gave us a straight answer in terms of what's the percentage return. So okay, so well, actually, let me finish this and I'll start another video.